This week, if you think a strong credit score and significant home equity will guarantee mortgage approval, think again. Many older Americans are being denied HELOCs or cash-out refinances, not because they're risky borrowers, but because they're retired. I'll explain why and where you can step in to help. We'll do that right after this short message from our sponsor, Liberty Reverse.
Liberty Reverse wants to help you grow your reverse mortgage business with our proprietary Equity IQ product suite. Equity IQ gives your borrowers access to more funds, lowers their upfront costs, and expands eligibility for home purchases. Learn more at partners.libertyreversemortgage.com today. This ad is intended for mortgage professionals only and is not a consumer solicitation. PHH Mortgage, doing business as Liberty Reverse Mortgage, is an equal housing lender. NMLS number 2726.
Welcome back and thank you for joining us. A 2023 New York Times article recounts the story of Molly Stewart, a 60-year-old recently retired attorney in Sacramento, California. She had a credit score over 800, nearly $400,000 in equity and decades of a work history. Her remaining mortgage balance, it was just over $100,000, and she even owned another house free and clear. Yet when she applied to refinance her mortgage for lower payments, she was denied. Why? It wasn't her credit history, and it wasn't for a lack of equity. It was her income. After retiring during the pandemic, her monthly income dropped, even though her assets remained strong. And from a lender's perspective, that made her a bigger risk. Now, from a common sense perspective, for the everyday person, it makes no sense. Now, unfortunately, this experience is not unusual. In fact, research from the Federal Reserve Bank of Philadelphia, it analyzed over 9 million mortgage applications, a big data set, and they found that denial rates rise steadily with age, even after you account for credit score, property value, and loan type. It found that overall refinance rejection rates were about 17.5%. However, applicants in their 60s, that rate climbs to 19% and 20% for those 70 and older. All of which begs the question, if age discrimination is illegal, which we know it is under the Equal Credit Opportunity Act, then why does age still appear to influence the outcome? Lenders are not going to cite the applicant's age directly, but they will weigh an older applicant's income, debt-to-income ratio, and also mortality risk. And then there are the concerns about the economic longevity of an older home under the term of the loan, especially if it's a 30-year mortgage. In short, today's modern mortgage system is optimized for younger W-2 wage earners, not asset-based underwriting. And that's the problem when nearly half of older Americans' net worth is tied up in their home equity. And even more so for Black homeowners, for whom housing wealth accounts for about 75% of their net worth. In the end, a home only becomes a financial asset if you can access it. But before we continue, I want to thank you for liking and sharing these videos. It really does help our channel. Also, consider subscribing. That way you never miss any of our latest episodes. And please subscribe to heckhamworld.com. That's where you can find all of our reverse mortgage commentary and analysis. With today's rates higher than they were during the pandemic era and underwriting standards remaining tight, tapping home equity has become increasingly difficult for older Americans. Policy researchers at the Urban Institute and the Boston College's Center for Retirement Research have warned that the income-centric underwriting rules today is leaving asset-rich, cash-poor seniors with few options. The study's conclusion states the relationship between age and rejection is large and robust. The equation includes lender by quarter year fixed effects, which means that the findings are not due to older individuals applying for mortgages with more stringent lenders. The lesson for the reverse mortgage industry is clear. If we don't rethink how creditworthiness is going to be measured in retirement, then we're going to have millions of older homeowners that remain equity rich, cash constrained, but locked out of tapping into their housing wealth, completely unaware of alternatives. But the good news is that we have more originators and brokers that are offering non-reverse asset-based equity loans, such as Longbridge Financial's HELOC for seniors and High-Tech Lending's Equity Select First Lien, and now we have just recently a second lien position. Now, each of those loans will require a modest payment, but that's a good selling point for the homeowner that is opposed to having an increasing debt on their home. And knowing this, it may be the time to reach out to your local banks and credit unions and provide a potentially viable option to their customers who are denied a home equity loan. And in doing so, you're going to be helping that older homeowner tap into their home equity, providing options for disappointed applicants, getting some pressure off the bank, and you'll be growing your pipeline. That's what we call a win-win-win. What are your thoughts? Leave your thoughts in the comment section below. And if you would share this video on your LinkedIn network, we thank you for that. As I mentioned earlier, we have a YouTube channel. Be sure to subscribe. And don't forget, each and every week, we're curating some very interesting stories here in our weekly podcast, Heck'em World Weekly. Listeners can listen and subscribe on Apple Music or Spotify. Thanks so much for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find right here at Heck'em World. Have a great week.